On the Module 2 practice worksheet, we're going to be working on journalizing entries utilizing the chart of accounts presented. Before we get into that, I want to go over a little trick you can use when you start working on your journal entries. What we're going to do is each step of this, we're going to evaluate the transaction, what's happening, what accounts are being affected, and which way they're moving. But first, we have to remember what a natural balance is for an account. And sometimes it can be a little bit difficult for us to have memorized every single account, what its natural balance may be. So it's good for us to go back and have a tool to be able to understand what the natural balances are for the categories of accounts. And what I like to use for that is an acronym we've got for ALICE. So I'm going to write it out over here on the left, ALICE. Okay, you see I've got them separated here a little bit because what we're going to do, we're going to go ahead and draw a line between it here and a line across the top. Now, we already went over in Chapter 1 that we have debits and we have credits. Debits are on the left and credits are on the right. So we're going to go ahead, list this side as our debits and this side as our credits. Now, I put Alice. That's how we're going to remember it. Our friend Alice here, A-L-I-C-E. But what does each of these stand for? A is for our assets. L is for our liabilities. I is for our income. C is for our capital. And E is for our expenses. And what does Alice help us find here? Alice is showing us the natural balances or you may hear some people call it the normal balances of these accounts. So what does a normal balance do or a natural balance do? It increases an account. All right, so if we have cash and we wanted to increase it, we would increase cash with a debit. We would increase expenses with a debit. A credit for our asset over here would subtract it, and a credit for expenses would subtract them. All right, now we kind of got the basic idea of how we're going to evaluate each one. Let's go ahead and jump into creating the journal entries themselves. So our first one here, we have Adriana contributed $20,000 in cash and $5,000 of supplies to her business, AS Services. So the first step we're going to do, evaluate what happened. Well, Adriana contributed cash and supplies to her business. Next, we're going to go ahead and identify what are the accounts being involved. Well, we know we've got cash that's going to be involved. We know we have supplies that are going to be involved, and she contributed them to her business. So what we're also going to have is capital being involved in this one. So cash came in. Cash is an asset. It's going up because she's contributing it to the business. Supplies is an asset, and it's going up. So I'm going to go ahead and look at the left-hand side again, and we see that assets, to bring them up, we're going to use a debit. So to make sure that our journal entries are in good form, we're going to make sure that we have a date that talks about it. We're going to put 1, I'm just going to call this X1 for the year. And the first one that I have here is cash. Now, when we're building our journal entries, debits always go at the top and credits go at the bottom. We don't mix them together. So if we have multiple debits, all debits go together. If we have multiple credits, they all go together on the bottom. So I'm going to recognize cash here for our $20,000. And then we are also contributing supplies. Of $5,000. These two right here, the cash and supplies, they're pretty easy to understand what their account names were because we're looking up here. The account name cash is cash and the account name for supplies is supplies. We already found out that this is going to go to her capital. So the credit here, when we come to our credits, we will indent them slightly. So I'm going to go ahead and indent it. I am going to use the account name as it's listed, Adriana Sanchez. Comma capital. And that's going to be for the total, right? So we've got $25,000 here. Whenever you are doing a journal entry, the balance on both sides have to equal. So I'm going to go ahead and just highlight these a little bit. We see that the total amount that we put on the left-hand side for our debits is $25,000. And the total that we put in for our credits is $25,000. So our journal entry here balances. Let's go ahead and move on to the second one using that same process. So services, AS Services is the name of the business, purchases $9,000 of equipment on credit. So we evaluate it. What happened here? The business purchased some equipment. That means we're going to expect our equipment account to go up. What is equipment? Well, equipment is going to be an asset. So we know that it is going to be a debit that brings it up. When we look over at our chart to the left, assets are brought up with a debit. Now I'm going to go ahead and look at my chart of accounts. Which one of my accounts looks like it would be for equipment? Well, in this one, we've actually got an account called equipment. So this was on putting it together. This transaction occurred on 1/3 of X1. And the account I'm going to debit is equipment. In the amount of $9,000. Okay, so it said on credit. You can think of this like if you purchased something on a credit card. You didn't pay cash for it yet. What you did is you've gone ahead and promised to pay someone in the future. So when I know that I'm going to have to pay someone in the future, I'm going to end up with something that is a payable. So I've got two on here listed as accounts payable and notes payable. What's the difference between the two of these? Accounts payable is more like your credit card. Think that you're going to go ahead and pay this off in the short term, maybe in the next 15 days, 20 days, 30 days, maybe 6 months. The accounting rule that we're normally going to look for is less than a year. Notes payable is normally going to be something listed that's longer term, thinking of something maybe a year or more. Oftentimes, notes too is something that we would expect to have a regular loan associated with, whether that's going to be a car loan or a mortgage, something like that. So with this equipment that we just purchased, it says it is on credit. It does not say it was purchased with a note. So we are going to go ahead and use the accounts payable. Now, accounts payable is a liability. So we see that our liability is over here on the right-hand side. And to bring it up, since it is underneath the credit up here, we use a credit to bring it up, which is why we're going to indent this slightly and we will have accounts payable. As our credit. How much is it going to be for? Well, it has to equal. Right? Just like above, our debits and our credits must equal. So we are at $9,000. Debit equipment $9,000, credit accounts payable for $9,000. Going to go ahead and move on to the next one. The business pays $200 cash for supplies. So I evaluate what we're doing. We've gone into a store. We've gone ahead and purchased some of our supplies. Maybe it's paper. They've given us some paper. We're giving them $200 in cash. So I know that my accounts affected are cash and supplies. Now what's happening with these? When we evaluated it, we said they gave us $200 in paper. Our supplies are going up. I had to give them $200 in cash. My cash is going down. Now I'm going to go back over to my chart at the left, and I am going to say both of these actually fall into assets. Both our supplies and cash are assets. So which one is going up? Supplies is going up. I'm going to need to debit it. So we've got our date here. Make sure we've got 1/10 of X1. I just said I'm going to need to debit supplies since supplies is our asset going up. And it is for this $200 that's listed. Cash is the one that's going down. Cash is an asset. To bring it down, it's going to come over here as a credit. So we're going to see cash as our credit for $200. All right, moving on to our next one. On January 15th, the business provides services and immediately collects $4,300. Okay, so if we collect $4,300, what are we collecting? Well, we are collecting cash. So that's going to be one of our items. Now, if we provide services, that means that we have created revenue. Soon as we complete our service obligation, we have created revenue under an accrual-based accounting system. So I know I'm getting cash over here. I provided my services, so I have revenue. In this case, we only have one revenue account. That is services revenue. So we're going to have to use services revenue as our account name. Now, revenue and the word income are used interchangeably. So I'm going to go back to my chart. Where do I see revenue? It falls under here under income. To bring it up, again, it's on the credit side. So we're going to go ahead and bring it up with a credit. So I know credits go second. That means I have to start with my debit. I've already identified that my debit is going to be cash, right? Someone paid us $4,300 in cash. So my cash over here, to bring it up, is going to be a debit. This was on the 1st, January 15th of X1. Someone paid us cash. Cash is coming in. Cash is going up, so it's going to be a debit for our $4,300. What are we having? We actually have revenue. The amount of income that we have is going up. We completed our services. To bring up a revenue account, we use a credit. We have to use the account name that is listed in our chart of accounts. We can't just use revenue. So we saw that our only revenue account is over here, account number 41, services revenue. So we're going to list this as a credit to services revenue for that $4,300. We see that we still balance here, so we are looking good. All right, now we're going to go ahead and complete the last one, which occurred on January 16th of X1. We'll evaluate what happened again. Our owner withdraws $500 of cash from the business for personal use. So our owner is taking out $500 from the business. I would expect my cash to go down, and we're going to have to recognize that cash coming out. So I know that cash is going to be one of the accounts affected. I know cash is going down. So I'm looking at my Alice accounts over here, and for cash to go down, it's going to be a credit. Okay, so what else would it be if they're going to go ahead and be our debit? Well, this is where we're going to have an account up here called Adriana Sanchez Drawing. Drawing recognizes that an owner has come in and taken money out of the business. There's nothing wrong with that. It is the owner's business. We just go ahead and show that the owner took their money out of the business. So we're going to go ahead and we are going to debit Adriana Sanchez Drawing. for the $500. And then we will credit what went down, our cash, for $500. And that's how we'll go ahead and complete these journal entries.